Hi, and welcome back to our Life Insurance Guide series, proudly brought to you by Life Insurance Direct. I'm Megan, and in today's video, we're diving into a topic that's super relevant for many of you, life insurance inside super. We'll unpack the pros and cons, how it works, and what it means for your retirement savings. To help us break it all down, I'm joined by our CEO, Russell Kane.
Thanks, Megan. I'm really excited to present in this topic. It's one of those topics that, a little bit of knowledge can really go a long way. And I think just becoming informed around the different pros and cons of having insurance inside super, what the options are, the cash flow benefits, some of the limitations, and also things to consider along with retirement erosion of your balance. So I think it's a really important topic, and looking forward to talking us through this today.
Thanks. So before we get into the details, here's a quick look at what we'll be covering in today's session. We'll start by looking at the different types of cover available inside super, what you might have already built in by default, what you choose to add, and what might be missing. Next, we'll break down the comparison between funded and super funded insurance, looking at how premiums are paid and what impact that could have on your retirement balance, the pros and cons of insurance inside super, and the differences between group and retail policies. After that, we'll walk you through a real-life case study so you can see how it plays out in practice. And finally, we'll wrap things up with some of our most frequently asked questions about insurance inside super. So before we move on, just a quick reminder, the information we're sharing today is general in nature. It doesn't take into account your personal circumstances, financial situation, or specific requirements. We always recommend getting personal advice before making any decisions about your insurance or your super setup. All right, with that covered, let's keep going. Before we dive deeper into how insurance inside super works, here's a quick look at what you're protecting when you hold these types of cover. Russell, can you walk us through the different types of insurance and what situations they're designed for?
Fantastic. So I think, with all my experience being in the life insurance area, I think the second most important decision is really about thinking about what are you wanting to protect yourself against. So just a quick recap, we have if you were to pass away, you unexpectedly were to look to pass away or had a terminal illness, you really want to be thinking about life insurance. Life insurance provides you that lump sum of money to provide for your loved ones in the case or your early demise or you becoming totally and permanently disabled. It's absolutely essential type of protection to consider if you've got family members, you've got mortgages that you might owe money on, and or you want to leave some money behind for the family and those loved ones if you're no longer around. The next one is your total and permanent disablement insurance. So total and permanent disablement insurance pays a lump sum of money if you are totally and permanently disabled to such an extent that you can either not perform your own occupation or any occupation suited to you by education, training, or experience. Just be mindful that we are specializing and talking about insurance inside super today, so you are not permitted to have own occupation TPD definition inside your super fund anymore. Some regulations some years back changed that. Therefore, just be mindful that we will be chatting and focusing more on the any occupation side of things for today. The other one is income protection. So income protection, or also known as salary continuance insurance, that pays a monthly benefit should you suffer a sickness or accident and be off work for a period of time, known as the waiting period. And that money is really about helping you fund your ongoing expenses so you can really focus on your recovery and continuing to pay those monthly bills as they come through, but you can then focus on that recovery side of things. And then we have critical illness insurance, and that is really about protecting you and providing you with a lump sum of money if you're diagnosed with a critical illness as defined by the insurer. So about 80% of all claims are from the four major ones. So we've got strokes, cancer, heart attack, and heart disease make up that 80% of those claims. And typically, depending on the policy, you'd be looking to cover yourself between 30 to 40 conditions if it's a standard policy, or an additional 10 to 15 conditions if it was a plus policy. Here again, trauma insurance is not permitted to be held within a superannuation environment, but important for you to consider as part of your overall insurance considerations when looking to protect you and your family. The most important thing is thinking about taking out life insurance for you and your family for the very first time. It's really important to think through when you should be considering life insurance. So typically speaking, we see people looking and considering life insurance, TPD, income protection, and/or trauma insurance when they're either starting a family, having a child, starting a family, getting married is definitely one of those life events. The other is taking out a mortgage for the very first time. The other is actually just getting older. People start to realize their mortality and go, maybe it's about time I think about getting some protection in place. And the other is where you're looking to take on a new job or a new career. Is quite often another time when people might be taking on income protection for the very first time and/or revisiting their insurance requirements. So when we talk about insurance inside super, what we're going to be talking about today is this is where we've got a life insurance policy or TPD or income protection policy that is going to be held within a superannuation environment. Now, what that means is that the policy owner of this insurance policy is actually going to be your super fund. Now, it might be your self-managed super fund. It could be a group super fund that we're going to cover off in a bit more detail that owns this particular policy, or it could be a retail super fund setup where we could have this owned by your self-managed super fund, or we could actually have it set up as a mini superannuation fund through this life insurance policy that we've just established, and we're going to roll over that money from your existing super fund to fund this particular policy. There's a couple of pros and cons that we need to just recap on before we dive into whether we should or shouldn't be using our super fund to fund our insurance premiums. Okay, so we'll go through some of the pros and cons, and then we'll dive into a little bit more detail on some of these. So first, we've got no out-of-pocket expenses when we're using our super fund. So effectively what's happening is you're using your superannuation monies to pay for those premiums, which is helping with your cash flow. So as opposed to using your after-tax money to fund your premium, you're now using your superannuation funds to fund that premium. It can definitely help with cash flow management. If you do have a tight budget or tight cash flow in the family, that's definitely one of the advantages of having your insurance fund through your super fund. The other one is that your premiums are tax deductible to your super fund. So be mindful of that. That's also a benefit of having your insurance funded through your superannuation fund. On the disadvantages side of things, so be mindful that when you are using your superannuation monies to fund your insurance, be mindful that you're eroding your retirement savings. So you need to really think about strategies and how to mitigate those down the track, right? So, because as you can imagine, if you take $1,000 out of your super fund to fund that premium, be mindful that's $1,000 coming out of your retirement. So you really want to think of strategies and how you can mitigate that over the long term, because otherwise it's going to leave you with less money at retirement. You also need to bear in mind when your policy is sitting inside superannuation, you're actually sitting in a different environment. So for you to have a successful claim to be paid that money to you personally, you need to meet both your policy terms and conditions of that particular insurance policy, as well as an SIS condition of release, okay, before that money will actually get paid to you. Because if you don't meet that second hurdle, the condition of SIS condition of release, what can potentially happen is you meet the policy terms and conditions and it gets caught up in your super fund, okay? So there is almost 2 hurdles to climb or 2 hurdles to meet before you get that money personally, because you need to meet both that policy terms and conditions as well as a condition of release under the SIS legislation. The thing to bear in mind is that some of our built-in benefits are going to be lost. So a lot of those policies that offer additional built-in benefits when you hold the policy personally, so your funeral advancement cover, your partial TPD or accommodation benefit, things like that, you might not be able to have, typically speaking, when you are funding this through your superannuation. So be mindful of that. You are missing out on some of those benefits as opposed to if you had them personally owned. The other one to also bear in mind, another disadvantage, if you are looking to fund your income protection through your super fund, typically speaking, your income protection premiums, when it's held in your personal name, is tax deductible at your marginal tax rate. If you are insured and you're the person paying for it in your personal name. However, if it's in a superannuation environment, you're only going to be able to claim, or your super fund's only going to be able to claim 15% of those premiums back as the tax deduction to the super fund. Typically speaking, that 15% is going to be a lot lower than a working Australian tax deductibility rate if you held it in your personal name. Here again, you also have that double layer situation with income protection as well. So just be mindful of those pros and cons before considering whether you should or shouldn't be funding your insurance through your super. Okay, so let's move forward and let's consider that you are really interested in funding your insurance premiums because it suits what you're looking to achieve better than funding it yourself. And then we'll talk about some different other mechanisms as well, where I might want some of my policy funded personally and some of my policy funded through my super, to try and see if we can, get some, I wouldn't say the best of both worlds, but definitely, improve some of those other outcomes or getting some of those other auxiliary benefits that we might have missed out on through optimal structuring of a retail policy. But firstly, let's think about how we can go about obtain insurance inside our superannuation environment. So effectively, superannuation has been around since 1992, and there's a lot of different super funds out in the market, but effectively most super funds, typically all of them, not all of them, but super funds will offer some form of insurance as part of their offering, okay? And that's typically going to be done through a group scheme. So a group policy or a group scheme is typically controlled by your super. Mindful of that. If we do have an industry fund, for example, that policy, that insurance policy is going to be controlled by the trustee of that superannuation fund. And typically speaking, because they're looking to cover, millions of members, it's going to have fewer policy features and benefits, and it's going to be a non-guaranteed renewable contract, meaning that at any time, the insurer or the super fund can actually go ahead and downgrade those benefits. So just be mindful of that. That's what that typically looks like. Also bear in mind, depending on where you're at, your age and the industry that the super fund is, sometimes those rates can be cheaper, but not always the case. It really depends on the individual super fund that you're currently with, your age, and the levels and types of cover that you're looking for. So really important for you to shop around, because don't just take for granted that your super fund's always going to be the cheapest going through a group scheme. Quite often that is not the case. The other thing to also bear in mind is that when you join your super fund, typically speaking, if you're over the age of 25, you will receive a default level of insurance. Now, that level of cover is typically far lower than most people would require, but it is typically through the automatic acceptance levels. So worthwhile investigating what the limitations are of that automatic acceptance cover. And often also you need to find out whether that cover is going to remain with you for the long term, or will it continue to reduce down as you get closer to that policy expiry age? Do they start to tear those benefits down? So quite often we see super funds, these group policies, reducing cover from 60, 65, 70, where they step that automatic acceptance level cover down and then potentially terminate it. Here again, there's thousands of superannuation funds. Important to investigate how it would work with your particular policy. Others might not also include pre-existing medical conditions. Here again, check those automatic acceptance levels. And or if you did want to increase cover, here again, fully investigate that PDS. And another common thing that we'll see with group policies is that they only offer a 2-year benefit period, as opposed to a 5-year benefit period, or even to age 65. Here again, you'll need to check the PDS and that relevant insurer, but worth definitely looking into if you are considering income protection. So on the retail side of things, typically speaking, you are in control of your policy. So what would happen in that particular environment? Retail life insurance policies are typically guaranteed renewable, meaning they cannot be downgraded at any time. So that's a fantastic feature because then you've got more certainty on what you're being covered for over the long term. You also have a choice of different premiums. So with group policies, typically speaking, you'll only have variable age stepped premiums available to you. However, in a retail environment, you also have variable premiums available to you. So that gives you a little bit more control as well on how you want to set up this policy, and or you're considering your cash flow requirements and or the affordability of the cover over the long term. The other thing to bear in mind is with retail, you get a lot more flexibility in how much you can be insured for. So typically for life insurance, there's no real limit on how much you can be insured for, so long as you can financially justify it. So you can really get plenty of cover if that's what you need. TPD, typically speaking, we could get up to $5 million worth of cover. Income protection, up to $30,000 monthly benefits. So be mindful of that as well. The other thing that's great about retail is that you can also use different features within the retail policy to actually help you secure the own occupation TPD or the trauma insurance part of a bundled or a combined policy. And they have this feature called super linking or flexi linking, which gives you this ability, which we're going to cover off in the next slide. The other one around income protection, you get far more waiting period options and benefit period options under retail policy. So you may want 30-day, 60, 90, 1 year, 2 year waiting period under retail policy. Benefit periods, 2 years, 5 years, 6 years, to age 65, to age 70. So definitely worth considering, if you are looking for something a little bit more customized and how you would like to go ahead and set that up. So for the next slide, what I'll be doing is I'll just be focusing on our retail life insurance policy setup. And what we're going to be thinking through is how we can go ahead and set up this retail policy. There's two fundamental choices that you have. The first one is you can either go ahead and use a self-managed super fund if you do have a self-managed super fund, which is option one. The other option is where you would go ahead and set up a mini super policy with the life insurance policy that you're looking to set up. So it's only an insurance only super fund, and there's no additional cost for doing this. However, what you're going to do is you're going to get a rollover from your existing super fund. So let's say, for example, Rest super fund. I'm going to ask Rest to go ahead and transfer over $1,000 a year, for example, if that was my premium. Ask them to go ahead and transfer or roll over that money to then go ahead and fund that premium. So be mindful that rollover would adjust each year depending on what your premium is and the levels of cover that support that. But that is a yearly rollover that would typically happen. So that's the way that you could go ahead and set it up if you didn't have a self-managed super fund. Fantastic. So let's go through and let's have a quick look at some of the flexibility that we have if we are choosing that retail super setup and how we want to go ahead and structure our policy. So we learned about the different types of cover earlier. And what you can see here in this particular slide is I have a life insurance policy here, for example, being owned in my self-managed super fund in policy number 1. And you can see over here in policy number 2, I have, for example, put own occupation TPD cover in my personal name. We've got trauma insurance here as well, sitting in my personal name. And then we also have the child cover here sitting in my personal name. So in this particular setup, it's called super linking. And how this effectively works is that, let's say, for example, I have $1 million worth of life insurance over here, $750,000 worth of total and permanent disablement cover here, and $100,000 worth of trauma cover. What ultimately happens is that they're all combined into one benefit. Okay, so the max that the policy is going to pay me out is $1 million in this particular example. So let's say, for example, I had a $100,000 payout on my trauma cover. that would then reduce my TPD cover down to 650,000, and it would reduce my life cover down to 900,000. Okay, so ultimately these policies are related, and they're typically known as a linked policy if it's outside of super. But because we've got part of that policy inside super and part of it outside of super, still as a bundled policy, it's called super linking. Now, this particular structure is going to be a lot more affordable for you versus standalone policies. Okay, so you could go ahead and set this up as a standalone structure where we wouldn't have this link in the middle, this chain in the middle here. And then what would happen is that if I was to have a claim on one standalone policy, it would not impact another standalone policy. Okay, so just be mindful that that kind of structure is definitely possible. However, it is going to be a lot more expensive, typically speaking, than a bundled or a combined policy. So it's totally your choice and how you want to set things up. But this structure is a very common structure for affordability. So you can ultimately get yourself broader coverage for less money, and it's an option that a lot of people will consider versus standalone policies. Okay. Now, if we were to take this one step further, the next concept I'd like us to think through is this concept about split TPD. Okay, so this particular concept here is where I would like to still have my self-managed super fund own my life insurance policy, and I also want to have my any occupation total and permanent disablement cover owned within that superannuation environment. Okay, however, let's say I'm a surgeon or a professional, and I really value having that own occupation TPD definition. But as we saw on the slide before, I didn't want to have all my own occupation cover here, like we saw here. I didn't want all of that sitting in my personal name. What I want is I just want to be able to put that portion of my TPD in my personal name. Okay, and it's known as split TPD. And what this ultimately is doing is this is putting the any occupation portion of your total and permanent disablement cover in your superannuation fund, and the any occupation definition is sitting in your personal name. Okay, so what would potentially happen is, let's say, for example, there was a TPD event. The first thing the insurer would be looking to see is, do you meet the any occupation definition TPD? Then potentially that's going to get paid into your super fund, and then hopefully you'll meet the condition of release and it'll get paid to yourself. Okay, if that was not the case and you did not meet the any occupation TPD, they would then look at the own occupation definition and see if you met that eligibility criteria. If you did meet the own occupation TPD criteria, then that would potentially get paid, or that would get paid directly to yourself and wouldn't go into your super fund. Okay, so that's what that kind of looks like. Be mindful here, these sums insured have to be the same. So let's say, for example, we had $1 million worth of life insurance and we had $750,000 worth of TPD cover, and the split setup. What that means is that the maximum you'll ever get paid for TPD is $750,000 combined. You'll either get it paid under the own occupation or the any occupation if you're eligible. Okay, the structure as well is a combined policy. So what would also happen is you would then, if you did have a successful any occupation TPD claim, that would then reduce your cover to $250,000 in this particular situation. So that's split TPD. The one concept that I'm going to go through next is I'm going to go through split income protection. Okay, so this is very similar to the split TPD scenario, except what we're going to be doing here is we're going to be putting the core portion of our income protection is going to be sitting in a superannuation environment, and those auxiliary benefits, the additional benefits, are going to be sitting in your personal name. Okay, so this is a concept here again where we're trying to get more of our premiums and our policies sitting inside a superannuation environment, and those auxiliary benefits sitting here inside my personal name. So this here again, it's a bit like the split TPD. The split income protection is very much where I'm trying to get as much of my policy inside the superannuation environment. However, I don't want to sacrifice some of those additional benefits or those auxiliary benefits that could be in my income protection policy. So I still want to get the kind of best of both worlds on that front. So something definitely to have a look at. So next, what we're going to do is we'll have a look at a case study, and let's see what this looks like in practice. So in this case study, what we're going to be doing is we're going to be looking at a 40-year-old male who's a non-smoker with no pre-existing medical conditions, living in New South Wales, seeking fairly comprehensive coverage. He's got $1 million worth of life insurance, $750,000 worth of total and permanent disablement cover with an own occupation definition, and we're actually looking at a split TPD setup here. $100,000 worth of trauma insurance, which we're going to super link, and also income protection covering 70% of his $100,000 salary. And we're looking at a benefit period to age 65 with a 90-day waiting period. Okay. In this particular scenario, we're also looking at putting that income protection in his personal name versus in a superannuation environment. Okay, so I'll just go ahead and we'll have a look at this case study. And what you can see here is we've got that $1 million worth of life insurance. We've got the total and permanent disablement insurance. Okay, and as you'll see over here, we've got that set up on the own occupation definition. We've got $100,000 worth of trauma cover. We've got a $100,000 salary, 90-day waiting period to age 65. And you'll see the monthly benefit with the $100,000, which is that 70%, is potentially $5,833 monthly benefit in this particular scenario. 40-year-old male non-smoker accountant living in New South Wales. We're looking at annual premiums because we want to get that savings. We want to look at that savings around that 6 to 9% savings paying annually. We're on a variable age step premium, and we're looking at a combination of both when it comes to our premium. We want to see, can we use both our superannuation fund and personally owned structure to scenario. Okay, so we'll go and have a quick look at what this looks like. And what we can see here is we have a NEOS policy here, another NEOS policy. So you can see this one here is the critical illness only, whereas this is the critical illness plus. So just mindful between the plus and the standard. However, what I wanted to show us in this particular breakdown is what does that premium structure look like? So let's go ahead and we'll click on this button over here, and you can see how this particular policy has been structured and how much of that premium is going to be paid between your super fund and yourself. Okay, so here we've got that $1 million worth of life insurance that we spoke up here. So we've got that life insurance sitting purely inside our superannuation environment. Nothing is getting paid by you personally. Here we've got the split TPD set up. Okay, so you can see here that $184.60 of that annual premium is being paid in your super fund, and $49.05 is being paid in your personal capacity, and that split TPD own occupation is held in your personal name. The trauma insurance can't be held inside a superannuation fund, so that's zero, and we've got $172.81 there. Income protection here again, we set this up so it was purely in my personal name, and that's $655.32. So here again, that's typically tax deductible at your marginal tax rate, and they will send out a tax statement to let you know how much you can claim on that. So that's there. This particular insurer doesn't have a policy fee, which is fantastic. So you can see here in this particular setup, you can see here we've got $473.42 being funded through your super, and personally it's $877.18. Okay, so you would be able to shift that income protection to super if you wanted to, but just want to show you how that might look in a real case scenario. So I think one of the key thing is to always remember it's just about really becoming informed, understanding what it is that you want to achieve right at the onset, thinking what your cash flow and your budget facilitate and can facilitate, and then working with a specialist broker to really find out, what's going to work for you, have a chat to them, understand the different options. And then once you've got a really good understanding on the types of cover and your budget and what that looks like, then you'll be really in a really good position to help you make a better informed decision on how you want to proceed with your particular insurance requirements for you and your family.
All right, thank you, Russell. So let's move on to some of our FAQs. So first up, I have, can I increase my default insurance through super?
Great question. Typically speaking, you can increase your default cover through super. However, it normally needs to go through underwriting. Okay, so it depends on each super fund on what flexibility they offer around this. But normally you'll have to go through a typical underwriting process. So fill in an application form. They'll review your cover and see if they will allow you to go higher than the default cover. The terms and conditions might be different. They might be the same. Here again, there's just, hundreds of super funds. So important to check that PDS.
Great. And next up, I have, what happens to my insurance if I change jobs or super funds?
Fantastic. I think that's a great question. So if you have group insurance, you need to be very careful, because if you do change employers or change jobs and you stop contributing to your super fund, your insurance policy can stop. So there are some different rules around that, and each super fund will be different, but there's also some legislated rules around that. So really important, if you do change jobs or do change roles, you keep contributing to that fund if that's your intention to maintain that insurance. However, if you were in a retail policy, for example, you could quite easily just go ahead and say, okay, fantastic, I want the new super fund that I've moved to or migrated to continue to pay that super fund, that policy. So it really depends on whether you've got a group policy set up or a retail policy set up on how you might want to navigate that.
All right, great. And could you tell us, is insurance through super cheaper than buying it directly?
Yeah, great question. So direct insurance or direct life insurance can be priced fairly high compared to group insurance and compared to retail insurance. So direct insurance policies, typically speaking, are offered by insurers directly or intermediaries directly over the phone. And typically speaking, there's less underwriting, and that means higher premiums. Group insurance is typically speaking more affordable than direct insurance, and the reason being is because the super funds have negotiated a bulk deal, quite affordable, and generally speaking, depending on the age that you're at, can be quite affordable and more competitive than retail. However, that's not always the case. It just depends on the cover and your age and the super fund that you're with. Retail's fully underwritten, so they know more about you, and can be priced, depending here again, quite sharply compared to group policies, can be a bit more, but it does give you a lot more flexibility and a lot more features and benefits. So it just depends on where you're at in your circumstances, but typically speaking, group and retail are going to be more affordable than direct policies.
Great. And another question we get quite frequently is, can I hold trauma insurance inside super?
No, unfortunately, you can't hold trauma insurance inside super. It's one of those types of benefits that is not well aligned to a SIS condition of release. So some years back, it was legislated that you can no longer hold trauma insurance inside a superannuation environment. So if you do require trauma insurance, if you're looking to purchase a trauma insurance, that will need to be held in your personal name.
Thanks, Russell. And next up is, can I fund my insurance policy through an SMSF?
Great question. Yes, so typically speaking, you can fund your insurance through your SMSF, and trustees have a legal obligation when, as part of their investment strategy, to consider the insurance requirements of their members. So typically speaking, they will look to set up a retail life insurance policy through their self-managed super fund that will go ahead and protect their relevant members. So whether it's one member, two members, or all of the members, just really depends on those particular members' requirements. But yes, that is a very common setup that we find, because trustees do have that obligation as part of their investment strategy to consider the insurance requirements of their members.
Great. And finally, can I fund a retail insurance policy through my existing super fund?
Great question. So yes, you can, and they do this by setting up like a mini superannuation fund with one of the particular retail providers. So normally what would happen is, let's say, for example, you've set up a policy with NEOS, as we saw earlier. What you may want to do is then have that NEOS mini super fund set up. There's no additional cost to do that. And then what will happen is, let's say, for example, that policy has now been established and it needs to now be paid for. What will happen is that you'll fill out a rollover form, and that rollover form will be sent to your existing super fund. So let's say, for example, it's Rest Super. You would say to Rest, hey, Rest, please could you go ahead and roll over that money to this NEOS policy, and that'll go ahead and fund that policy for the year. And then it will continue on each year, so long as you've got that rollover policy, so that rollover arrangement in place, that will continue for as long as you hold that policy.
All right, thanks, Russell. That covers off all of the FAQs we had today. Yeah, thank you for joining us today. I think we've covered off quite a lot, from how insurance works inside super to strategies like super linking and the pros and cons of insurance inside super.
Fantastic. Well, thanks, Megan. Really appreciate the session. And any further questions around insurance inside super, please feel free to reach out. It's a fantastic topic. It's a fantastic opportunity to become educated in how you can fund insurance for your family, and or consider different ways on how you could structure that if you do have some unique requirements.
Thanks, Russell. And don't forget to like and subscribe, and join us next time for more.